Wall Street professionals faced $2 billion in losses betting against GameStop while Reddit traders made profits buying the rally. But wait, the greatest investor of all time once suffered losses buying up a rising stock, so which is it, buy high or buy low? Let's start with the 2021 GameStop incident, a notable lesson in buying the dip or shorting in Wall Street terms. Hedge funds like Melvin Capital saw a video game retailer facing challenges and bet its stock would drop. They borrowed shares and sold them, planning to buy back cheaper later, classic short selling. But here's the issue: they shorted 140% of GameStop's available shares. That's naked shorting, selling stocks you don't actually own. Then a Reddit user named Keith Gill posted a plan: buy and hold. Retail traders joined in. As the stock rose, Melvin had to buy back shares to cover their baits, but there were no shares left. This short squeeze pushed GameStop from $17 to $505 in 2 weeks. Melvin saw its assets shrink by 53% in days, totaling over $1 billion. This isn't an exception. Look at the S&P 500. Between 1999 and 2013, it showed no significant gains, but 52.8% of trading days were up, 47.2% down. Short sellers have a lower probability of profits because stocks can't fall below zero but have upside potential. A $10 stock has a maximum downside of $10. But upside could reach $100, $1,000, even $10,000. Those retail traders who bought GameStop at a high price could only watch the stock decline, facing losses from blindly chasing rallies. So is buying the rally more secure? Look at Peter Lynch's experience, the investor who grew $10,000 to $280,000 in 13 years. In 1983, he bought Texas Air stock after it dropped from $12 to $4.75. He saw potential value. The airline owned stakes in other carriers, and the economy was recovering. By 1986, Texas Air had risen 10 times to $51.50. Lynch was overly optimistic at the time. He ignored risk signals, rising baggage loss rates, frequent flight delays, union disputes at acquired airlines. In 1987, he added more shares at $48.25 right before the stock correction. The stock dropped to $9. Lynch ultimately avoided losses but missed out on considerable gains. His mistake: confusing a temporary rally with a sustainable trend. Modern data confirms this risk. A 2025 study tracked late-day rally chasing, buying stocks that rose 2% in the last 30 minutes. 50.7% of those stocks declined the next day. Even when they rose, 58% gave back all gains by noon. Rallies have uncertainty, especially when large investors paint the tape to influence the market. True investment thinking isn't about wondering by the rally or by the dip, but about understanding easily overlooked patterns in the market. An easily overlooked pattern in the market is upside probability doesn't equal actual returns. The S&P 500 has only a 2.8% more up days than down days, but return potential varies significantly. A $10 stock that falls 50% needs a 100% gain to break even. But a stock that rises 100% only needs a 50% drop to give back all gains. GameStop's rally wasn't accidental, it was specific market context. Short sellers had excessive leverage. Texas Air's stock correction wasn't a timing issue, it was ignoring fundamentals. There's no absolutely correct answer, but 3 ideas can help optimize investment decisions. First, avoid extreme operations. Melvin shorted 140% of GameStop's shares. It's recommended not to put more than 1% of your portfolio into a single trade. Second, focus on capital flow, not market noise. Lynch missed Delta Airlines, which rose 50%, while Texas Air corrected because he ignored the rally signals from competitors. Third, set stop losses appropriately. The 2025 study found traders who executed stop losses when stocks fell 5% had a 41% higher probability of profits than those who held on. In 2021, those facing losses weren't the short sellers, they were the ones who bought GameStop at $500. In 1987, those missing out on gains weren't the rally buyers, they were the ones who ignored risk signals. The key isn't buy high or buy low. It's whether you have a clear investment plan.